Welcome back to the Raw Selection Private Equity Podcast. Joining us today is Sequoya Borgman, founder of Borgman Capital, a lower to middle market private equity independent sponsor. He's going to share his journey from setting up the firm in 2017, challenges that he's faced, and how he's overcome them. Let's dive in. Sequoya, if you can share a brief insight into you, please.
Yeah, and be happy to. Thanks for having me on the show. So my background, I came out of school, I got a master's in accounting and joined one of the large public accounting firms, Arthur Andersen at the time. Really focused on transactions most of my career. After Andersen, I went to a couple of other big firms and really got interested in private equity transactions, M&A. Did that for about 20 years. Was a partner and really decided at that point in my career I wanted to do something a little bit more entrepreneurial. So a lot of my private equity friends that I was working on their transactions with, they were having a lot more fun. So I decided to leave public accounting and start a private equity firm here in the Midwest. And that was 2017. And really haven't looked back since then. So eight years we've bought 19 companies over those 8 years, and we have 2 more under LOI that we're close to closing on here shortly. So we'll be over the 20 mark soon, and really focused on nice cash flowing, established lower middle market businesses all around the country. We buy businesses that are under 200 million revenue, under 20 million of EBITDA, mainly family or founder-led businesses. We've got an office here in Milwaukee where I am, and we've got another office in Minneapolis, and we just added a kind of a value creation lead out on the West Coast. So we're kind of spread out over the country, looking at about 1,500 deals a year, and again, really just looking for nice lower middle market companies. We've got 13 people on the team, and we can do average of 3 to 4 acquisitions a year.
Perfect. Well, congratulations on the journey so far. What is one mistake that you see private equity firms or portfolio companies making, and what do you suggest to correct them?
Well, it's all about people. I mean, you're really investing in people when you're buying these lower middle market companies. The founders, that transition from a founder-led company to more of a professional managed business, that's a huge risk. I see that mistake made quite a few times. We've personally made that mistake, just hiring the wrong leader to replace a founder. Maybe they don't have the right cultural fit, or they try and do too much too fast and really chase off either some key employees or some key customers. That happens quite a lot. So we try and do everything we can to really manage that risk, keep the skin in the game with the founder, and have their interests align with our interests. I mean, we want nothing more than for that business to continue to be successful, and for the most part, founders want their businesses and their legacies and their employees to continue to be successful as well. It's just how you go about that is sometimes where the tricky part comes in.
How are you mitigating that then? Because the change from founder owner to what is in perpetuity an employee, most entrepreneurial types owner profiles don't tend to lean to that too well, and there's a reason usually why they're selling. So how have you mitigated that factor of when that transition happens to try and make it more effective or less painful for the owner founder?
Yeah, sometimes the founder's staying around for a longer period of time and in for the second bite of the apple, but the majority of the business we buy, the founders transition out after 6, 12, 18, 24 months. And I find that the best way to make that transition happen is just be very open and honest with the founder, have them be very open and honest with what they want to do with the business after they transition out as well. And as you said, most entrepreneurs, most founders start a business, own a business because they want to be the top decision maker. They don't want to be told what to do. And it's tough when you have new ownership. They don't have control. There's an outside board. People have maybe great ideas, but it's not aligned with what that founder wants to do. So we try and wait till we bring in a new president before we really start implementing our kind of value creation plan. We don't force those changes down the founder or the owner's throat when they're still running the business. So it's kind of a slower process. We found that works a lot better than really day one coming in and really trying to transform the business. So it usually takes maybe 12 or 24 months before we start implementing the value creation plan.
Perfect. And from you mentioned 19 acquisitions so far, so congratulations, more than two a year currently. What lessons have you learned that you wish you knew at number one that you've adopted into number 19?
Again, it's all about the people. The businesses, I mean, they go through cycles. And over the last 5 years, really, with the challenges since COVID started, there's been ups and downs through all the businesses. So there's always one that's kind of having more outside challenges than any. But those, I mean, as long as you focus on the fundamentals and what's within your control, those end up well. It's more the people side of the business, managing the people, managing the leaders, having the right leaders in place. That's again the biggest challenge in this. It's not finding the businesses, it's not financing the businesses, it's not putting the equity in. It's really the people dynamics. It's almost more HR driven than it is anything else. Especially again these smaller middle market businesses. They don't have the resources a large organization does. They don't have all the departments and the professional groups that can help with a lot of the challenges that pop up on a daily basis on these businesses. So that's again the biggest challenge is just the people side of the business.
Sorry to interrupt. Just a quick mention of a long-standing partnership with Grata. As you will probably know, the private equity scene is constantly evolving, and deal flow is moving now to proprietary and data-driven processes. Grata provides you with the data and information of over 7 million private companies. So if you're looking to improve your proprietary deal flow and improve the data access, then reach out to Grata today. Now back to the podcast. So what have you done to drive that? Obviously, small businesses, not enough divisions, etc. Not the big support of a G or whatever in the big blue chip corporate world. What are you doing as a PE firm to support that to enable the growth?
Well, like I said, we have 13 people on our team. We've got one of our MDs is his background. He ran very large corporations, former CEO. So he helps out really on a weekly basis with all the leaders, and then we bring in resources as needed. We don't wait when things need to be made, changes need to be made. We have all the HR consultants and different recruiting groups that we've worked with in the past to bring in the right individuals to lead those businesses. And we find that's key. If you have the right leader in place and the right leadership team, the rest of the things fall in place.
Awesome, awesome. So, from a independent sponsor perspective, as you guys have elected, firstly, why did you go down that route and not the traditional fundraising or fund raise route?
Yes, good question. I mean, originally the plan was to do a couple deals and then raise a fund like most no most new managers. But after the first couple deals, fortunately, I mean, we started in a great time. 2017 was a great time to start a firm. I think it would be a lot tougher right now in the current fundraising and financing environment. So a lot of times it's better to be lucky than good on a timing standpoint. But we started off like I said, right in the middle of a great decade for private equity, and got a couple great deals in that first year. And once we had a committed investor group, which was established really right off the bat, there was really no need to raise a fund. I mean, besides that first deal, we've been oversubscribed on all of our acquisitions from day one. And we now have a very established group of over 450 LPs that have invested with us over that 8-year period. So there's really the equity side of the equation is not the hard part. It's the finding great investment opportunities is the hard part. So with that being the challenge, we've just decided not to raise a fund to this point. I'm not saying we wouldn't do it sometime in the future, but I mean, there's been some articles recently about a large rise in independent sponsors, and that's driven by the hardest part is find the investment. It's not the equity. The equity's out there. So I think a lot more managers are choosing to go the independent sponsor route. Just it gives you the flexibility. You don't have one fund mandate where you have one industry focus. You can be a lot more opportunistic around which deals you want to pursue and which opportunities are present themselves. And the hold periods. You can have a longer term hold period that definitely resonates well with sellers who a lot of times don't want to sell to somebody that's going to flip the business in 2 or 3 or 4 years. They've normally grown that business over a 30 or 40-year period, and they want to sell to somebody that can hold for a 10, 20-year time frame. And with our model, we're able to do that.
Is that typical for you guys to have an extended time frame from a hold period perspective? Are you mostly 10, 15 years plus, etc.?
I mean, we're just like any other private equity firm. We're driven by cash on cash returns and IRR returns, and the shorter hold periods do drive a higher IRR, maybe not a higher cash on cash return. So there is alignment and some pressure from the investors to have a shorter hold period. So once you exceed your investment expectations, my thoughts, and if it's a good market, is to sell those businesses. But we can, if it's a nice cash flowing business, we can pay distributions and hold for 10, 15, 20 years as well. We have that flexibility.
So you referenced obviously 450 kind of LPs and building that investor base to fuel you. Have you typically taken that? I'm assuming from a making the most of the kind of newish retail individual investor landscape as opposed to traditional kind of institutional capital.
Yeah. So I mean, from the beginning, our investor backing was primarily family offices and high net worth individuals, ultra high worth individuals, and that has just grown over the years. And as they talk to each other, then their colleagues get into the next deal and so forth. And then last year in 2024, with kind of this rise in the retail investor focus, we actually launched a separate platform, PassTheHat.com, that is really focused just on retail investors, accredited investors, high net worth individuals that want access to kind of lower middle market deal flow that they may not have access to at the time. And a lot of the bigger firms are establishing these retail funds primarily through IRAs and other sources, but there's few platforms like ours that give you access to direct investment and kind of a leverage buyout model. There's a lot of platforms for real estate investments and for venture capital investments, but you for kind of traditional private equity.
95% of all business problems are people problems in disguise. Over the last 6 months, I've been intently writing a brand new book, all focused on the experiences that I've collated from some of the top private equity firms and investors on how they interview and select top executive talent for their portfolio companies. To go on the waiting list for this book and receive a free copy for the first 100 added, please check out the show notes and get your name on the waiting list today. You shared the difficult part for you guys can be the deal flow element. You've obviously appearing on this podcast, get the brand out there. What else are you doing to try and increase the amount of deal flow exposure and obviously evidently people choosing Borgman over somebody else?
Yeah, the finding good investment opportunities at reasonable valuations is the hardest part of what we do and what all the private equity funds out there do. It's a competitive landscape of good businesses have plenty of buyers out there. And we do see, like I said, we see over 1,500 deals a year. A lot of those are investment banked or brokered deals. Those are a lot of times not the best investment opportunities from us personally. We like the ones where we're introduced directly to the founder. We established a relationship and a level of trust with that founder, and we are able to agree to some terms that really align with their future vision of that business. Those are the best opportunities for us, and those are the deals that we're really looking for. Or somebody out there, there's other independent sponsors that maybe it's a one or two person group, and they just need a partner, some help to get a deal done. Maybe they find a deal, they have it under LOI, but they don't have the equity, or they don't have the resources for all the diligence and what it takes to get a deal over the finish line. We'll partner with other groups to do deals as well.
What besides obviously coming on podcasts like these, what else have you done to try and increase your exposure, increase the awareness of you and the firm?
Yeah, I mean, like I said, our focus, we've got individuals around the country, and I feel like those best proprietary deals you find through your local network. So sitting in secondary cities where you know all the M&A advisors, the attorneys, the accountants, the insurance guys, the corporate bankers. That's where you find those best opportunities. I feel like just having people in other locations, and we are continuing to. We're talking to a couple people right now that join the firm. We would have other like deal origination individuals that want to join us that do sit in a market that we're not in right now. We see that as kind of the future growth for the firm, and that's where we find the best opportunities. It's just we're introduced through our network to somebody that wants to sell their business.
Makes sense. Makes sense. So, what are your influences, Sequoia? What do you read, watch, listen to that you recommend that others check out?
Well, besides your show, of course, but no, big podcast listener. I love the Acquired podcast show, and I think everybody listens to All In these days. So those are two of them. But I read everything I come across. A lot of books on my night shelf right now. Where I'm actually going through a AI Made Simple book right now that I'm halfway through. I think AI is really transforming what we do and our industry and all our businesses as well. There's a lot of efficiencies that can be gained. I was just talking to one of my partners this morning about how we can get those 1,500 sims we look at each year analyzed by AI. It would save a lot of modeling and time for all of our analysts. I know they would love that. So if there's somebody out there with an AI product that can kind of maintain the confidentiality of those types of information and help us analyze those books, please reach out to me.
Something that we've leveraged significantly. What else have you taken? I'm interested in the AI piece. We've begun to leverage that into our business. What else have you taken from the AI book, if anything yet?
Just the daily stuff. I've used it personally quite a bit for vacation traveling and all that kind of stuff. But I mean, just our attorneys have advised us. I mean, a lot of the stuff that we do, it's very confidential. We sign lots of NDAs, and it's very hard to use some of the large platforms to analyze and help us, and even record our board meetings and stuff like that without more confidentiality kind of guardrails around AI.
Yeah, it makes it difficult. So you said you're a big reader. Is there any other? What's your kind of two top books that you recommend everybody should read?
I'm reading Do Hard Things right now. That's a great book. I climbed Mount Kilimanjaro last year. I'm big at like pushing yourself both mentally and physically. So I highly recommend that book. But that and yeah, this AI book I would highly recommend it. It's called AI Made Simple. It's changing. They should probably write a new book every month because it's moving so quick. But I do think that that's really going to impact all the businesses that we invest in and really the whole industry overall. So staying ahead of that, I think, is key for anybody out there listening.
Absolutely, it'll bring some certain opportunities for everybody to leverage it. So Corey, if anybody wishes to reach out, how best do they get in touch with you, please?
Yeah, they can reach out to me through our website. We've got boardmancapital.com or credit investors of interest in looking at our investment opportunities, PassTheHat.com or through LinkedIn. A lot of people reach out to me through LinkedIn as well. So multiple ways to get in touch with me.
Perfect. Well, thank you very much for coming on the podcast, sharing your journey so far. 19 acquisitions and two more hopefully incoming pretty soon, and give us an insight into what it's like running your independent sponsor and your journey so far. So thank you for coming on.
And thank you for having me.
And of always, thank you very much for all of our listeners for yet again tuning in to the Private Equity Podcast. Till the next time, keep smashing it, and thank you very much for listening.